What is going on in the interest rate market? Hunter, that's what I want to talk to you about today because rates have really accelerated lately. Just in the past few days, especially the last week or so, we've seen the 10-year, the 30-year hit recent highs, and it's causing some concern among investors. And so, what I'd really like to get into today are really the short, medium, and long term dynamics that are really playing into that.
Yeah, and we're talking about some big moves for what's generally a slow moving market is 30 years back up to levels we haven't seen since 2007, and the 10 years back up to peaks that we haven't seen since January this year. It moves a little bit more, but both of these are pretty extreme levels and have happened really in the past few months. So I'm excited to dive into this because there are a lot of things going into it, and I think the short, medium, long-term perspective is a great way to break it down.
Yeah, so kind of just starting off with the magnitude of the move. I mean, we're seeing the 10-year yield today is right around that 465, 467 type range. And when I say that, I mean 4.65%. But at the start of the Iran war, we were at 3.92%. So you're talking roughly 75 basis points of increase on the 10-year in what's been an 80-ish day period. I mean, that's a very quick move in rates. And whenever we talk about the short-term dynamics, why has this shifted so rapidly? I mean, it's really all about oil. It's all about Iran. It's what's going on in the Middle East. And I kind of want to start with that as far as our short-term indicator for what's going on in interest rates.
Yeah, and so taking a look at it, whenever oil is spending so much time above $100 a barrel and will likely continue to stay in the $90 to $100 barrel for a while now, going forward, probably for the rest of the year, depending on who you ask. Those are kind of the estimates that are being thrown around. Is a direct contributor to inflation. Is oil. Energy makes up a large portion of inflation. Oil also finds its way into other areas where transport for individual goods, transport for people as far as airline flights, et cetera, et cetera. It finds its way through other pieces of inflation. And so whenever you have this future inflation that you're expecting, that we will see pick up in the numbers. We saw a little bit of it last CPI print. Your bond investors want to be protected from this because whenever you're investing, you need a certain, inflation risk premium. And so you need a premium on inflation because if you're investing in bonds and not keeping up with inflation, then your buying power over time is slowly dwindling. And so, yeah, I've heard that a number of different ways, but probably my favorite is, when people say it's a safe way to go broke slowly, is that your buying power is being eroded if you aren't capturing that inflation in there. And so, as we've seen in the bond markets, bond investors want to be compensated for that and ensure that whatever they're agreeing to earn for the next 10 or 30 years is going to compensate them fairly for that.
Yeah, and I mean, you make a really excellent point there because what did we see in early 2023? It was because banks were caught off sides with a lot of bonds on their balance sheet or a lot of fixed income on their balance sheet that was originally issued at these very low yields. And then we saw interest rates spike in 2022 when the Fed rapidly rose rates to fight inflation last time. And that's when you kind of get into this mismatch as you're talking about, going broke slowly. In that case, going broke quickly because, whenever we think about how should an investor get compensated for a government bond? Well, traditionally in any kind of, especially fixed income asset, you're going to have a combination of a risk premium, but whenever we talk about government bonds, we essentially assign zero risk premium to them because we don't foresee the government going broke. We foresee them always paying back their bond issuance. Granted, we can talk about that piece in a whole nother podcast, but you essentially are assigning zero risk premium. So it's a combination of how long are you holding this bond? You have to get compensated for the the maturity of the bond and how long it lasts. That's why your later term bonds, as you go from 1 to 5 to 10 to 30, they're traditionally increase in yield. There's some dynamics when it comes to the Fed on that, but it's also that inflation premium. So you have to have that inflation risk premium because you don't want your purchasing power to get degraded over time with inflation. So I think that's really the lens that we should kind of look through as we're talking about how to value these bonds. And to your point, as that inflation premium increases, investors are going to demand more from their government bond yields in order to compensate for that. So as long as those inflation, especially these short-term inflation expectations, are heightened, investors are going to demand more from the yield on their bonds.
Yeah, exactly. And so that's what we've seen since the Iran war kicked off, 80 days ago, is a mad dash upwards for bond yields. And, until that gets resolved, I think we're going to, continue to see elevated yields, which leads us into the medium term. If things, continue along this path, no matter really what path they take, medium term, we start looking at what the Fed reaction function looks like to what's going on in Iran, but also what's going on with inflation in general. So, Victor, do you want to run us through that real quick?
Yeah, so this follows from the expectations of oil and oil prices, and it's starting to play into the Fed's rate policy calculus. And as I like to remind our listeners, and I'm sure if you listen to our episodes, you've heard me say this before, but the Fed has really two pieces of information that play into their policy decisions, and they're looking for maximum employment, so maintaining low unemployment, and then price stability, so maintaining low inflation. And between those two things, of course, we're talking a lot about the inflation picture right now, and that's all because it's really all the Fed is having to focus on right now. Luckily for broader economic purposes, the job market has stayed fairly healthy. We've seen a pretty stable job market. And so when it comes to that piece of their agenda, whenever it comes to that piece of the calculus playing into their policy decisions, they don't have to worry about the job market right now. We haven't seen a major loss in jobs. Of course, there's talks about AI and what's going on in the broader economy, but so far, at least in the formal data, we haven't seen any issues, with the consumer, with the labor market. And so they're hyper fixated on the inflation piece. And I think as the Fed thinks through their next policy decisions, their next rate changes, it's how long is this oil price inflation that's really driven by a single event, being the Iran war and the Middle East conflict, how long does that trickle through into broader prices? Because the longer it does, the more it starts to impact their longer term thinking about inflation and how that plays into their rate policy decisions. But they also have to consider, hey, if oil prices are going to come down following a resolution of this conflict, we can't make rate decisions based off of something that's going to go away. Now, I hate to bring up the T word, being transitory again, but I think some of this inflation certainly is transitory in the fact that oil will not stay elevated if we find a resolution here.
And I think this is going to be a very interesting thing to watch, the Fed calculus going into this, because usually for the Fed, they have very unanimous votes at their policy meetings. Even if there's some bickering behind the scenes, they usually keep it behind the scenes and show a united front. And we've seen that fall apart over the last few meetings already, is that you have people voting for different tracks of Fed policy, maybe with their own merits, but, not getting into that today, but, both different avenues to conduct Fed policy already. And now you have the newly appointed Kevin Warsh to be leading the Fed, and you have this inflation that's driven by a shortage of something. This is kind of what you could refer to as a cost push type of inflation, is that oil is going up in price because of a geopolitical event. It's not anything that the Fed can hike rates to resolve. Making financing more expensive isn't going to fix the fact that it costs people in businesses more to fill up their long haul trucks, their individual cars, their passenger jets with fuel by raising interest rates. So it's going to be an interesting thing to watch in that perspective too.
Yeah, I want to kind of highlight that point because what you said is very important regarding the cost push nature of this inflation is that cost push inflation is not really impacted by Fed operations nearly to the extent that demand pull inflation is. And so the differentiation between those two, you already did a pretty good job of explaining it. But, whenever the Fed conducts what we call hawkish operations, so monetary tightening, whether that be higher interest rates or quantitative tightening by purchasing bonds and pulling money out of the market, they're looking to destroy demand essentially. Fewer dollars, chasing more or the same goods should mean that there's, deflation or lower inflation in the market because the traditional definition of inflation is too many dollars chasing too few goods. Well, if you want to ramp up inflation, stir up the economy, put more dollars in the system, make it cheaper to borrow, or buy bonds and pump dollars in, that being dovish operations in that stance. But we're talking about, like you said, cost push inflation, which they cannot impact so much because they are not on the controlling side of that equation. Now, if it were demand pull because the economy is just rip roaring and there's so much demand for oil and that's what's causing oil prices to increase and the price of everything else, well, that's when they can pull money, dollars out of the economy, slow things down, temper inflation to some extent. But it's really important to consider that dynamic. And the hope is that enough Fed members understand the difference between those things to where they wouldn't just hike rates in order to, hopefully lower oil prices, because the fact of the matter is that's just not going to have that big of an effect. So I feel like we did a pretty good job kind of talking about this being that medium term, call it the next 6 to 12, 18 months as far as what's going to impact the rate market. I mean, it's important to understand and to know that when we're going into this year, most analysts were looking at roughly 2 interest rate cuts by the Fed. Those have been completely priced out at this point. Some people are even talking about Fed hikes. I'd say we're in the camp that we don't expect hikes because of what we just talked about, because of the difference in inflation dynamics. But it's certainly going to be interesting to see. And as you mentioned, with Kevin Warsh coming in as Fed chairman, it could be a new type of regime. So that's something that we'll keep a close eye on for sure.
Yeah, and it's going to be very interesting to watch all of that. And I think kind of an extension of Fed policy, related at least, is kind of what we view as the long-term dynamics going on. And that's largely surrounding the U.S. debt. It's been an issue for a while. We've been talking about it for a while, but it continues on the same trajectory that it has been. And I think it's getting a lot more attention by bond investors as well as the Fed whenever it comes to what that means for rates. Now, the Fed traditionally, and has done a good job of it, does not comment on U.S. federal government actions, but at the same time, it does impact the job that they're trying to do, because whenever you have a huge amount of government spending and debt-driven spending, means a whole bunch of bond issuance that has to be consumed by the markets that on its own will naturally push those bond yields up, because people want to be more compensated and have to be, one, enticed into purchasing more bonds, but two, also want stronger returns to compensate them for what has traditionally been quoted as the risk-free rate that may now have incrementally more risk associated due to this trajectory of government spending.
Right. I mean, you make a great point. The federal deficit, it was, 1.2 trillion in the first 6 months of fiscal year 2026. The total of government debt has, is past $39 trillion at this point. And if you talk about future obligations, I mean, you're at astronomical numbers. And so this is a serious issue. And I think today is not the time to kind of figure out ways to solve the national debt. So we won't get into that kind of discussion, and we'll save that for another podcast. But it is starting to play into the conversation. I feel like every 2-3 years, investors want to start talking about the debt and deficit again, and as how it's impacting bond yields. And I feel like we saw that in kind of the 2022-2023 timeframe. And I feel like it always kind of arises when you have these uptick in interest rates, because it's the government that's paying that interest on those bonds. And the more interest they have to pay, the more of a deficit that they drive. And so I think that's certainly starting to play into the longer term interest rate dynamic. And it's something that needs to be watched. I wouldn't say it's too much of a risk right now, but I think it certainly isn't going to bring interest rates lower over time. It's only going to increase it until they kind of fix the deficit and the debt spending.
Yeah, and I think, kind of going back to what we mentioned at the very top of the episode, is that one of the traditional ways to get out of huge government debt levels is to inflate your way out of it. And so I think that's another thing that can push bond yields higher, is that they see, okay, if this isn't sustainable, then it either adds risk or adds risk of inflation further on, especially when you're looking at purchasing a 30-year bond that you intend to hold to maturity. Well, that can be a real concern if you see this continuing along that path, that inflating your way out of your debt might be something the government is enticed to do down the road. Now, there are a number of other ways to get out of it. Like Victor said, that's a whole other podcast in itself. So we'll address those at a later time, but just another concern for bondholders there.
Yeah, definitely. So I think we did a pretty good job of laying out kind of the short, medium, long term. Short being Iran and the oil market, medium being the Fed reaction function, and then long term being the government debt and deficit. The only other factor that I think I'd like to mention before we kind of talk about our conclusion and wrap up here is that foreign buyers, I think, is an interesting piece of the demand side for government treasuries. You mentioned how much we're having an issue because of all the debt spending. Well, someone has to soak that up. And I think you have consistent demand from domestic buyers, but traditionally international central banks and treasuries have purchased U.S. government treasuries, and they will continue to do so. There's a huge demand for U.S. dollars. We continue to be the global reserve currency. But I feel like foreign buyers are starting to step away to some extent from the U.S. Treasury market, leaving more for domestic purchasers to soak up. And whenever you have these supply-demand dynamics, if there's lower demand, it's going to mean that there's going to have to be an increased price, or in this case, increased yield, in order to drive that demand replacement. And so that's also another factor kind of playing into bond yields that I think is pretty interesting and something that I've certainly been watching.
Yeah, no, it's definitely an interesting thing to keep an eye on, because you've seen a broad foreign push, just central banks around the world, not so much directed at the U.S. necessarily, but directed at all other governments to begin with. And this is something we talked about in our previous gold podcast, is that with so much geopolitical upheaval around the world, just different changes to the status quo that we've seen for decades, people feel safer in things like commodities, and are just looking to diversify their exposure, because no central bank or government wants to be overly reliant on anyone else. And so it's not no more U.S. debt, it's new U.S. debt, but also more gold, more this, that, and the other, that other foreign governments are looking at too.
Yeah, definitely. And so as we kind of conclude, I think it's important to note how this relates to the broad market, and especially the equity market. I think it's going to be difficult to see the market really take another leg higher with interest rates being where they are. I mean, we saw huge returns coming out of the late March lows, and the market run has been fairly exceptional, certainly impressive. But with yields where they are right now, it's going to be challenging, I think, for that next leg higher in the market. So we kind of need that to resolve itself before we move forward. Secondly, I think you and I don't expect Fed hikes this year. I think anyone who's calling for Fed hikes has kind of lost sight of the reaction function. We dove into that with the inflation dynamics. I can picture not having any cuts this year, but I think hikes are kind of out of the question, at least for now.
Yeah, exactly. Especially like we've mentioned before, the Fed can control the demand picture. They can't, snap their fingers and create more barrels of oil. So
I wish they could.
that'd be nice. So we're watching that. But to that point, once we see the Iran situation become finalized in one form or another, Strait of Hormuz open back up, then I think you'll see yields come down pretty quickly, at least to an extent. I think maybe your first, 20, 30, 40 basis points on the 10-year back down closer to what we saw in February is not unreasonable, just because it'll take time for the global oil price to settle back out, because even if you're producing enough barrels, there's still a limited supply of ships who can get that to where it all needs to go overnight. So that's not going to happen overnight. But, the bond market will react more quickly than the global oil price will. So even if price stays elevated, you can see those yields come in pretty quickly on that, hopefully get back to a more normal space there.
Yeah, I certainly hope so. Well, Hunter, thanks for the conversation today. And for you listening, if you have any questions about interest rates, market dynamics, drop us a comment, shoot us a note. I'd be happy to answer. Thanks for tuning in.
Thanks, Victor.